Welcome to the Deep Dive. We're here to cut through the noise of today's finance and investment news.
That's right.
Forget feeling overwhelmed by headlines. We pull out the really important bits, the interesting stuff, and tell you what it actually means.
Yeah, we try to make it clear, focus on what you, as someone interested in finance, really need to know.
Exactly. So today we've got 5 key stories. We'll break down what's happening, why it matters, and crucially, what the potential impact could be on your investments. The financial world can seem complex, we know that,
Uh-huh.
but our goal here is to make it understandable. Ready to jump in?
Let's do it. Think of this as your fast track to understanding the big picture. These stories aren't just random events. They often link up, signal shifts.
Good point.
We do the digging so you get the essentials and, grasp the potential consequences.
All right, first up, a name most people will recognize, Capital One. The headline goes something like, Capital One to pay $425 million over savings account interest rates. CFPB drops related lawsuit. So a couple of layers to this one.
There are. It's really about how they handled interest rates on their savings accounts. Lots of folks had the original 360 savings account.
Okay.
Then, back in 2019, they launched a new one, 360 Performance Savings. And this new one offered, well, much higher interest rates, significantly higher.
Right. And you'd think, okay, new, better product. Maybe let your existing customers know. Give them the heads up.
You would think so. But that seems to be the core of the issue. Reports suggest Capital One instructed staff not to proactively tell those existing 360 savings customers about the better rate.
Wow. So you had people earning what, maybe 0.3%?
Something like that, yeah. While new customers, or those who found the performance account, were getting over 4%. That's a huge difference.
It really is. Can you give us a sense of what that means in, like, dollar terms?
Sure. Let's say you had $10,000 sitting in that old account for, say, 5 years. You might have earned maybe $186 in interest, give or take.
Okay, not a lot.
Not really. But that same $10,000 in the new performance account,
Yeah.
over the same period, you could be looking at more like $1,090.
That's quite a gap. Over $900 difference on 10 grand.
Exactly. It adds up fast, especially if you had more saved. And when you scale that up across all the affected customers, the estimate is they lost out on over $2 billion in potential interest nationwide.
$2 billion. Okay, so it's no wonder this ended up in court, a class action lawsuit, right?
That's correct. Alleging unfair and deceptive practices. And that lawsuit has now led to this settlement. Capital One agreed to pay $425 million back to those affected customers.
So if you had one of those original 360 savings accounts, you should probably keep an eye out for some kind of notification.
Definitely. Payments are expected to start going out in early 2025, so be watchful for emails or mail about the settlement.
Okay, but then there's this other wrinkle with the Consumer Financial Protection Bureau, the CFPB. They also sued Capital One.
They did, yeah.
Right.
Early 2025, they filed their own lawsuit over the same practices, but then things changed.
Changed how?
Well, in late February 2025, the CFPB actually withdrew their lawsuit, pulled it back.
Why would they do that?
The official reason given was policy changes. Changes in direction following the 2024 elections and new leadership taking over the agency.
Ah, so politics playing a role in regulation. That happens.
It certainly does. And as you might expect, consumer advocacy groups weren't exactly thrilled about the CFPB dropping the case.
I can imagine. What was their main concern?
The worry was about the signal it sends. If regulatory bodies back off after political shifts, does it maybe encourage other companies to push the boundaries, thinking scrutiny might lessen later? It shows how these bigger political currents can impact individual finances.
Interesting. Okay, so pulling it all together, what does this Capital One situation mean for investors or just, for regular people managing their money?
Well, first, practically speaking, if you were a Capital One 360 savings customer, look out for that settlement info. Don't miss out if you're owed money.
Right.
But the broader lesson here is really about being proactive with your own finances. Don't assume your bank will automatically give you the best deal or tell you about better options.
Good advice. Check yourself.
Exactly. Regularly check what products your bank offers, especially savings accounts or CDs. Ask about higher yield options. You can make a real difference. And second, it's a reminder that consumer protection agencies like the CFPB, their priorities and their enforcement focus can shift.
Based on politics.
Based on politics, based on leadership. It's something to be aware of, both as a consumer and if you're investing in the financial sector itself. Regulation matters.
Makes sense. Okay, let's shift gears. Story number 2, headline. China imposes high tariffs on key plastic imports from U.S., EU, Japan, and Taiwan amid trade tensions. Sounds impactful.
It definitely could be. We're talking about a specific plastic here, polyoxymethylene copolymer, or POM for short.
POM plastic. Okay, what's special about it?
Well, it might sound technical, but it's actually a really important material. It's very strong, durable plastic, often used as a substitute for metal parts.
Mm.
Think things like gears, fuel system components in cars, connectors in electronics, even parts for medical devices. It's pretty versatile stuff used across a lot of industries.
So, fundamental for manufacturing. And China, a huge manufacturing center, is putting tariffs on it from major economies. What exactly are these anti-dumping duties?
Right, so anti-dumping duties are basically extra taxes. A country puts them on imported goods if they believe those goods are being sold unfairly cheap, below production cost, or below the price in their home market.
That's called dumping, right? To undercut local producers.
Exactly. China started investigating this back in May 2024. They concluded that companies in the US, the EU, Japan, and Taiwan were dumping this POM plastic into their market.
And the tariffs are steep, especially for the US.
They are quite high, yeah. For the U.S., the duties can go up to 74.9%. That's substantial. The EU is around 34.5%, Japan 35.5%, Taiwan 32.6%. Though there are some exceptions for specific large companies in Japan and Taiwan, they get lower rates.
And this is happening even though there was recently that 90-day pause in the bigger US-China trade spat.
That's right. The U.S. had raised tariffs on Chinese goods. Then there was this truce announced. But China went ahead with these specific POM duties anyway. It shows that even with broader talks, specific industry disputes can still move forward.
Okay, so what are the likely consequences here? What kind of fallout could we see?
Well, several things. First, manufacturers inside China who use this imported POM, their costs are likely going up.
Which could mean higher prices for things made in China.
Potentially, yes. For consumers globally, eventually. Second, it obviously adds more strain to international trade relations. We might see other countries respond with their own measures.
Tit for tat.
Could be. Third, you've got the risk of supply chain disruptions. If companies can't get this plastic easily or it becomes too expensive, that could slow down production in automotive, electronics, medical, lots of areas.
Right.
And finally, economists worry that if these kinds of trade fights keep escalating, it drags on global growth, could even increase recession risks down the line.
So, for investors looking at this, what's the key thing to watch?
Well, you need to be aware that these trade disputes can directly hit companies' bottom lines. Higher material costs mean lower profits, potentially hurting stock prices.
Especially companies relying on those specific imports.
Absolutely. And think about the ripple effects. Supply chain issues can impact whole sectors. So if you're invested in automotive or electronics or even medical tech, this is relevant. It just adds another layer of uncertainty to the global market. Volatility.
Got it. Okay, let's bring it back home for story number 3. This one's about retail. Headline: Kroger abandons ambitious ship home delivery marketplace after multi-year expansion. A big shift for a big grocer.
It really is a significant pivot. Kroger Ship, launched back in August 2018, was their big play for nationwide home delivery. Not just groceries initially, but their own brands and some other items.
Trying to compete with the online giants, I guess?
Pretty much. They offered free shipping early on, trying to get people hooked,
Yeah.
and then they really ramped it up. Well, August 2020, they partnered with a company called Miracle. The goal was to create a proper third-party marketplace. Suddenly, Ship wasn't just Kroger stuff. It was toys, home goods, all sorts of things from other sellers.
Ah, like an Amazon or Walmart marketplace model?
Exactly. Then in April 2022, they added another big partnership, Bed Bath & Beyond, bringing in home, kitchen, baby products.
Ah.
They even talked about putting Bed Bath & Beyond sections inside Kroger stores.
Right, I remember that. And they seem to keep adding brands, even picking up inventory from Bye Bye Baby and Bed Bath & Beyond after those chains ran into trouble.
They did. It looked like full steam ahead on expansion, which makes the recent news a bit surprising.
What exactly happened?
Well, pretty quietly, actually. In March 2025, they just stopped. They shut down the Ship marketplace for home delivery of all those third-party products.
Just like that. So no more nationwide shipping of, like, toys or towels from Kroger.
Nope. Now, to be clear, Kroger still does grocery pickup, and they still do local grocery delivery from their stores. That's not changing. But the big, ambitious nationwide marketplace, that's gone.
Any official reason why?
They haven't given one, no. So we're left to kind of read between the lines.
What do the lines suggest?
Likely a mix of things. I mean, the online delivery space is brutally competitive, right? You got Amazon, Walmart. It's tough to carve out space.
Sure.
Maybe customer habits shifted. Maybe the demand wasn't quite what they hoped. And running a huge marketplace like that, it's expensive. Logistics, warehousing, customer service for thousands of different products and sellers, it costs a lot.
Yeah, that makes sense. So what can investors take away from Kroger's ship experiment?
I think it really hammers home just how intense the competition is in e-commerce and home delivery, even for a giant retailer like Kroger, with stores everywhere. Breaking into that national non-grocery delivery market is really, really hard.
Shows the power of the incumbents.
Definitely. It also highlights the sheer cost and complexity of building and running those big online marketplaces effectively. And maybe it shows companies knowing when to pivot.
Adapting.
Yeah, adapting and refocusing. It seems Kroger decided to double down on its core strength, groceries, offered through pickup and local delivery, playing to their advantages.
Okay, interesting. Let's move to the stock market itself now. Story 4. U.S. stock market roller coaster. Plunge after tariff announcement, followed by strong rebound. Definitely felt that ride.
Oh yeah, it's been quite volatile. Remember, early 2025, the market was actually doing pretty well, near record highs. Things felt generally optimistic.
And then came the tariff talk.
Exactly. Early April, President Trump announced these new proposed tariffs. A big baseline one, 10% on basically all imports, plus higher ones on specific things, like that 34% on Chinese goods we mentioned. The idea, he said, was to protect U.S. industries.
But the market didn't like the sound of that, did it?
Not at all. The reaction was fast and pretty brutal. Investors immediately worried about higher costs, messed up supply chains, other countries hitting back with their own tariffs.
The whole trade war fear scenario.
Precisely.
Yeah.
And the S&P 500, it dropped about 12% in just 4 days. That's a sharp fall, really shook confidence. Experts started murmuring about recession risks again, GDP shrinking, wages falling, jobs lost, profits down.
Scary stuff. But then, almost as quickly, things changed direction again. The 90-day pause.
Right. On April 9th, just days after the initial shock, President Trump announced this 90-day pause on implementing most of those new tariffs. China was still included in existing ones, but the broad new ones were put on hold.
To allow time for talks, presumably.
That was the idea. And the market breathed a huge sigh of relief. Almost instantly, sentiment flipped. Fears of a full-blown trade war eased, and stocks started climbing back up. The S&P 500 began a strong recovery.
And that recovery has basically continued into mid-May. We saw that winning streak recently.
We did. The S&P 500 had a good run, even turned positive for the year. Tech stocks in particular did well, leading the rebound.
So what's behind this comeback? Why the optimism now?
Seems like 4 main things are driving it. First, there are whispers, maybe frameworks, of a potential U.S.-China trade agreement. That helps calm nerves.
Okay.
Second, inflation data recently came in a bit better than feared. That reduces pressure on the Federal Reserve to hike interest rates aggressively.
Always a big factor for the market.
Huge. Third, corporate earnings for the last quarter were actually pretty decent, surprisingly strong in some cases. Companies are managing okay, it seems. And fourth, there's growing hope or expectation that the Fed might actually cut interest rates later this year if the economy cools down.
Right. Lower rates are generally good for stocks, makes borrowing cheaper.
Exactly. Stimulates investment and spending.
Now, speaking of the Fed, they just met in May and kept rates the same, right? What's the thinking on future cuts?
Yeah, they held steady. But honestly, there's still a lot of uncertainty. Some analysts are penciling in multiple rate cuts later in 2025. Others think the Fed will wait and see, be more cautious, watch the data closely.
So it depends on inflation and jobs numbers, mostly.
Pretty much. Lower rates could definitely help stocks, but the Fed won't rush if inflation stays sticky.
So even with this nice rebound, are there still things investors should be cautious about, reasons things could turn south again?
Oh, absolutely. It's not all clear skies. Consumer confidence, for example, is still kind of low in recent surveys. People are wary. And consumers' expectations about future inflation still pretty high. That could make the Fed hesitant to cut rates too soon. And of course, the big one, those trade talks could fall apart. The tariff threat hasn't completely vanished.
Right, the pause is just a pause.
Exactly. So, yes, the market's shown resilience, which is great, but investors need to stay alert. Things can change quickly.
So the big takeaway for investors from all this market drama?
I think it just really underscores how much government policy, especially trade policy like tariffs, can jolt the market. Investors react strongly and quickly on that stuff.
Yeah, you saw that clearly.
And it shows how sensitive the market is to economic data, inflation, earnings, and of course, to every word from the Federal Reserve about interest rates. Even after a recovery, uncertainty remains. Vigilance is key.
Okay, on to our final story. This one looks ahead, way ahead perhaps. Headline: Walmart gears up for future where AI bots could be your primary shopper.
AI shopping for me sounds wild.
It does sound a bit sci-fi, doesn't it?
Yeah.
But it's something big players like Walmart are seriously thinking about and actually preparing for. The idea is AI shopping agents computer programs that could automatically do your shopping for you.
Like I tell my AI, get me groceries for the week, find the best deals, and it just does it.
That's the general concept. Yeah, imagine an AI assistant that knows your preferences, your budget, your usual shopping list. It could browse online stores, compare products, make the purchases, maybe even handle returns.
That would change everything about retail. It really would. It flips the model. Instead of companies marketing to you, the human, they might increasingly need to market to your AI. The AI becomes the customer, in a way.
So how is Walmart preparing for this? What are they actually doing?
Well, a couple of things. They're building their own AI tools. They have something called the Wally AI Assistant for their merchants, for example. But importantly, they're also updating their back-end systems, their e-commerce platforms, so they can smoothly interact with third-party AI agents.
Meaning AI agents from Apple or Google or whoever develops them.
Exactly. Your personal AI, potentially. The goal is to make it seamless, whether you use Walmart's AI or your own. They're thinking about how these agents will browse, compare, buy, handle reorders, all that stuff.
How would that work securely? How does Walmart know it's my AI buying stuff and not some rogue bot?
Ah, good question. That's where these new autonomous shopping protocols come in. Think of them as the rules of the road for AI shopping. They'd cover things like how an AI agent proves it's legitimate, how it gets secure access to real-time information like prices and stock levels, and how it handles payments safely. Walmart wants to be involved in setting these standards now.
Get ahead of the curve.
Precisely, and influence how it develops.
This must also mean huge changes for advertising, right? How do you advertise to an algorithm?
That's a fascinating question. The thinking is that traditional ads, the ones that play on emotions or fancy visuals, might not work so well on an AI.
Because the AI just wants the specs and the price.
Pretty much. It'll likely focus on objective data. Product specifications, features, price, value, maybe reliability ratings. So companies will need to make sure all that data is accurate, easy for an AI to find and compare. It's a shift from, say, emotional branding to more data-driven marketing.
Why is Walmart investing in this now? It still feels pretty far off for most of us.
It might feel far off, but the pace of AI development is rapid. Walmart probably sees this not as a question of if, but when. By acting now, they position themselves to be a leader, not a follower, when AI shopping becomes more common. It's about future-proofing.
So for investors looking at retail or tech, what does this Walmart move signal?
Well, it's a huge signal about the ongoing transformative power of AI,
Yeah.
especially in retail. It shows major companies are actively planning for a future where AI plays a much bigger role in consumer behavior.
So opportunities in AI for retail.
Could be, yeah. Companies developing those AI agents or the systems that support them. It also makes you think about which traditional retailers are adapting, like Walmart seems to be doing, and which might get left behind.
And it changes the game for marketing and brands, too.
Absolutely. How will brands build loyalty if an AI is making the final choice based purely on logic and price? It raises big questions. Investors should definitely keep an eye on how AI is reshaping the entire retail landscape.
Wow. Okay, that's a lot to digest. We've covered quite a bit today.
We really have.
Let's quickly recap. We talked about the Capital One settlement over savings rates and that CFPB lawsuit withdrawal.
And the lesson about checking your own bank rates.
Then China's new tariffs on that key plastic, POM, and the potential global trade impact.
Right. Higher costs, supply chain risks.
We looked at Kroger shutting down its ambitious ship marketplace, highlighting the fierce competition in e-commerce.
The costs involved, yeah.
Then the stock market's wild ride, the tariff scare, the rebound fueled by trade hopes, inflation data, earnings, and Fed speculation.
Showing how sensitive markets are to policy and economic news.
And finally, Walmart getting ready for a future where AI might be doing our shopping for us.
A potential revolution in retail.
So the connecting thread seems to be constant change from regulation, trade, competition, technology. It's all shifting the ground beneath our feet.
That's a good way to put it. The financial world never really stands still.
So as you think about your own finances, your investments, keep these things in mind. Maybe check your savings rate. Consider how trade tensions might affect companies you follow. Watch how retailers adapt online. Understand what moves the market. And yeah, maybe ponder what an AI shopper would mean for you.
Absolutely. And maybe here's a final thought to chew on. If AI does become your primary shopper, focused purely on specs and value, how does that change your relationship with brands? Does loyalty even matter to an algorithm?
Good question. Something to definitely think about as technology keeps reshaping our world.